All right, let's just dive right into this. Today, we are opening up the ultimate master craftsman's toolkit for investors. We're going to completely demystify relative valuation, and we're using the exact framework developed by the legendary finance professor Aswath Damodaran. Valuation isn't just about pulling a number out of thin air, right? It's about having a structured, incredibly rigorous method to evaluate literally any asset. Our core goal in this explainer is to hand you the precise instruments you need to stop pricing assets based on pure speculation and instead finally anchor your investing decisions in cold, hard reality. To really set the stage here, think about this brilliant quote from Oscar Wilde. He once said, "A cynic is one who knows the price of everything but the value of nothing." It really makes you ask yourself, when you invest, are you secretly falling for the bigger fool theory? You know the one. That's the incredibly dangerous game of buying an asset totally regardless of its underlying value, just crossing your fingers and hoping a bigger fool will come along later and pay you more for it. Damodaran's work is a huge wake-up call that price must always, always be backed by reality and expected cash flows. Because if it's not, well, you aren't really investing, you're just gambling. So here is our quick roadmap for today's breakdown. We'll start with the rules of the game, then move on to mastering earnings multiples. After that, we'll go beyond earnings and look at book value, followed by revenue and sector multiples. And finally, we'll wrap up with the master key, finding the companion variable. First up, Section 1, the rules of the game and the 4 steps to multiples. Okay, before we pick up a single tool, Damodaran outlines a really strict 4-step process to make absolutely sure the tool actually fits the job. First, you have to define the multiple consistently and measure it uniformly across the board. Second, you've got to describe its distribution, meaning you need to know what a high, low, or typical value actually looks like across the broader market. Third, analyze the fundamentals. You have to understand what variables are fundamentally driving that multiple. And fourth, apply it to truly comparable firms while carefully controlling for their differences. Seriously, if you skip even one of these steps, your entire valuation could just fall completely apart. Let's really hammer home that golden rule from step 1. Consistency. If your numerator is an equity value, something like market price, then your denominator absolutely must be an equity measure, like earnings per share. That's what we call an equity multiple. But if you're calculating a firm multiple, let's say using enterprise value, which factors in debt, then your denominator has to be a firm measure, like EBITDA. Mixing the two, that is a literal cardinal sin in valuation. It results in comparing apples to oranges, and it's a mistake you just can't afford to make. Moving right along to Section 2, mastering earnings multiples, which are really your standard everyday tools. Let's open up the toolkit and look at the most common instrument out there. But heads up, even the simplest tool, like the PE ratio, can be incredibly tricky. Take Apple back in May of 2011, for example. There were just massive variations in its PE depending on whether analysts used current, trailing, or forward earnings, not to mention whether they used diluted or primary EPS. Think about it. A bullish analyst might cherry-pick a forward PE to argue the stock is dirt cheap, while a bearish analyst uses current PE to claim it's way too expensive. The big lesson here? You must define your tool uniformly across every single firm you're comparing, or your analysis is just hopelessly biased right from the get-go. Now, sometimes a standard PE just doesn't cut it, right? Especially when you're looking at really high-growth companies. Enter the PEG ratio. This is simply the PE multiple divided by the firm's expected growth rate. It's a specialized, modified tool specifically designed to control for those wild growth differences across firms. But, and this is a big but, use it carefully. Damodaran warns us that the PEG ratio implicitly assumes a perfectly linear relationship between multiples and fundamentals. Basically, it assumes that if a company's growth doubles, its PE should exactly double too. And honestly, in the real world, valuation is almost never that perfectly linear, so definitely use this one with a healthy dose of skepticism. So let's shift gears to a firm multiple, enterprise value to EBITDA. When you look at heavily capital-intensive industries, like steel companies for instance, EV to EBITDA is essentially the perfect tool. Why? Well, because these infrastructure-heavy firms have massive, massive capital investments, and the ways they handle depreciation can vary wildly. By focusing on EBITDA, we move higher up the income statement before all that messy depreciation completely clouds the picture. Plus, by using enterprise value, we're properly accounting for their different debt levels. It wonderfully standardizes everything, so you can finally see the true operational value of the underlying business. Section 3. Beyond earnings, taking a look at book value. What if we want to value a company not based on what it manages to earn, but on what it actually owns?
Historically, there is an absolutely fascinating relationship between a company's price-to-book ratio and its return on equity, or ROE. Over time, these two metrics track right alongside each other beautifully. Sure, stocks selling well below their book value are often flagged as undervalued, but you can't just look at that ratio in a vacuum. A low price-to-book ratio is really only a bargain if the company can actually generate a strong return on that equity. Otherwise, it might just be cheap for a very good reason.
And while we're on the subject of assets, we absolutely have to talk about Tobin's Q. This is such a brilliant academic tool, named after economist James Tobin. Instead of obsessing over accounting book value, Tobin's Q compares the market value of a firm to what it would physically cost to replace every single one of its assets from scratch today. Imagine literally rebuilding the whole shebang. If a firm's market value is sitting way below its physical replacement cost, theoretically, it's a steal. Now, finding that exact replacement cost data in the real world is incredibly tough, but conceptually, it is a wildly powerful way to think about true intrinsic value. All right, Section 4, Revenue and Sector Multiples. Think of these as your highly specialized tools.
So what exactly do you do when a young, exciting startup is bleeding cash with negative earnings, or when weird accounting rules make its book value completely meaningless? We pivot to revenue. When you dive into the mechanics of price-to-sales and value-to-sales ratios, you quickly realize their superpower. They completely strip away accounting choices. Revenue is incredibly hard for a company to manipulate with clever accounting tricks. The value-to-sales ratio, which is enterprise value divided by revenues, is especially rock solid. Because it's internally consistent, netting out cash and factoring in debt, it makes it super easy to compare companies across totally different global markets. It's a real game changer.
Now, sometimes analysts like to go even further into the weeds and use sector-specific multiples. We're talking metrics like value per subscriber for a massive streaming service or value per barrel of oil for a refinery. These attempt to standardize value by looking at the actual physical operating units that generate the revenue. But hey, a massive word of warning based on our framework, these tools are essentially scalpels. They are highly specialized, but incredibly easy to slip up with. Why? Because two companies could have the exact same number of subscribers, but totally different profit margins on those subscribers. If you ignore those margins, this tool will lead you straight into a massive valuation trap. And that brings us to Section 5, finding the companion variable, which is, without a doubt, the master key. This is the final, ultimate secret of Damodaran's entire framework. Every single multiple is unlocked by one core fundamental driver. We call this the companion variable. Think about how these line up. For the PE ratio, that core driver is expected growth. For price to book, it's return on equity. For price to sales, it's net margin. For EV to EBITDA, it's the reinvestment rate. This means if you see a stock that looks unbelievably cheap just because it has a low multiple, you must check its companion variable first. Like we said earlier, a stock with a low price-to-book ratio isn't necessarily a hidden gem. It probably just has a horribly low return on equity. Understanding these companion variables is quite literally your ultimate defense against buying into value traps. So we've fully unpacked the Master Craftsman's Toolkit today. We went from setting strict rules of consistency all the way to unlocking those crucial companion variables that drive genuine value. The next time you're sizing up a stock or any asset, I really want you to challenge your own habits. Stop just looking at the price tag. Look under the hood at the fundamentals driving that price. Ask yourself honestly, are you truly paying for value based on a rigorous, structured analysis, or are you just hoping for a bigger fool? Keep the lessons from this explainer in your back pocket before you make your next move in the market. Thanks so much for joining me on this deep dive.